morning, everybody. I'm Cameron Neely with Ellsworth Advisors, sitting here as always with my partner Kelly Keenan. We wanted to shoot a quick video this morning to address a topic that started to receive some press. Obviously, we're in the middle of this COVID-19 pandemic, and that has caused a virtual shutting down of the U.S. economy, the global economy, really. And the U.S. government has acted very aggressively to try to prop up the economy. Recently, Congress passed a $2.2 trillion relief package. Many believe that that is just the tip of the iceberg, and ultimately the U.S. government could end up putting together relief packages, whether it's infrastructure, individual bailouts, reorganizations of whole industries, packages that could equate to $10 trillion $10 trillion by the time it's all said and done. And that really begs the question. I think a lot of our clients realize that the U.S. has a bit of a spending problem. Politicians love to spend money, and what we've seen over the last several years is the spending going up, the deficits going up, and the revenue not, keeping up with it. Eventually, if you borrow too much, you don't make enough, you come to an inflection point. A lot of times it's called bankruptcy. So the question, and I want to get your thoughts, Kelly, is the U.S. going to go bankrupt?
Cam, that's a loaded question. So, deficit situation, the U.S. just general debt, just the amount of dollars in treasury bonds that the government owes over the last decades. Obviously, our deficit exploded and our federal debt exploded ever since the 08-09 crisis. It was increasing consistently, prior to that. The reality is government debt is a lot different than household debt. As an individual, yes, if you are laden with debt, you go bankrupt and start all over again. Governments are a little bit different, and U.S. being unique in that we are the reserve currency of the world. The rules are definitely don't necessarily apply in the same way. When you look big picture, okay, the U.S. has a lot of debt, but so does every other nation or other major nation in the world. China, their debt situation is a disaster. Europe is not good. Japan, not good. Those are the major economies. Everybody's laden with debt. And Japan, they've gone the last 20, maybe 30 years now. Well, yeah, 30 years now where, they've run huge deficits and they haven't gone out of business. Japan is still Japan. In the U.S., you have a situation where, one, it's relative to the rest of the world. And, the debt really comes down to, if you have too much debt, can we default on it? No. Who's there to collect? The other reality is a lot of that debt is owed back to us anyways. It's the Federal Reserve buying the debt from the Treasury, creating money. So if you want to call it money printing, money printing is absolutely going on. Does that cause inflation? Theoretically, it should. It hasn't up to this point to any strong degree. The deficit hounds will point back to, the collapse of the Roman Empire is because they had too much debt, and they had a lot of other issues going on too, But so it's not the same as what we've seen in the past. Inflation isn't necessarily caused by, one theory is inflation is caused by printing money. It's a monetary phenomenon. But if that was true, how come we haven't seen inflation in the last 10 years? How come Japan hasn't seen huge inflation? The inflation people will point back to, what about Germany and between World War I and World War II during the Weimar Republic? Well, they had hyperinflation, but also they had basically very demand for goods and no demands to provide. So you had definitely supply shortages. In the 70s, we saw high inflation in the U.S., but that was because of the wage price spiral, where a lot of wages were geared around union escalation contracts, where wage prices went up as inflation went up. You had an oil crisis, oil shock. Those prices went up. They caused wages because of union contracts to spiral up. That was a different type of situation. It wasn't necessarily a monetary situation. So, that's the risk with printing money is the inflation side. On the debt side, okay, who do we pay the debt to? Well, it's pay it to ourselves. Yes, but then again, you owe it to yourself. So is it really debt? Another point that gets, another issue that gets pointed, China holds, I think, $14, $15 trillion of U.S. treasuries. Well, what if they sell them all? What if they want the money? Well, okay, if they want it, what they're going to do is to sell those, they're going to drive down the price in what they're going to get anyways. And also that would collapse their currency. Like I said, the Chinese economy or the Chinese fiscal situation is not good at all, even though they sit on a ton of treasuries. The reason they sit on treasuries, they sell stuff to us, we pay them in dollars, and what do they do with the dollars? They have to turn around and they park the dollars in treasuries. So it's not, if they want to cash out, good luck.
So it seems one day
crash your currency.
It seems like one day all the big governments are just going to get together and say, you know what, let's start over again.
Well,
we forgive this, we forgive that, and
there are economists, they call it the Great Reset, where at some point there could be a big reset. And in that situation, at that point in time, if you own stuff, you own property. Well, property, no matter what the revaluation is going to be, your property is worth something, and it's going to be relative to other property. You own that property. You still have the use of that property. There's still value there. What the denomination is, it doesn't matter. The value is there. In owning companies, in owning equities, you're owning a piece of a company. That company is producing profits in whatever metric that's going to be. Those profits will continue to grow based on human nature and the way business works. So if you own producing assets or things that no matter what the denomination is, whatever the currency is,
they have
the
intrinsic
value is, it's intrinsically going to go up. Versus if you own a lot of cash gets devalued, you're out of luck. If you own bonds or debt, that's where the risk is. So big picture, you want to own assets that have intrinsic value that is more than just in an interest rate. But you also have to hold cash and interest rate vehicles to provide that liquidity in the short term to live on.
Diversification.
So that's the diversification. That's how you kind of have to look at it. And the U.S. defaults on their debt. That the rest of the world's going to have a lot of issues, anyways. I mean, we're fortunate to live in, the country we live in. We're the most, financially sound. We are the reserve currency of the world. There's nothing changing there. China's not going to be the reserve currency. Russia's not going to be the reserve currency. The euro's not going to be the reserve currency. Japan's not going to be the reserve currency. It's really the only option. So, in the grand scheme of things, it's not going to change the dynamics, at least at this point in time. Now, I'm not an economist. These are high-level thoughts. But, logically, things evolve in economic theory, and we're seeing it happen. We've seen it happen over the last 10 years. Models evolve. What worked in the past doesn't necessarily work now. And as investors, we're not locked into any kind of dogma as to how we want to invest. Our job is to, deal with what's coming down the pipe. And when it comes down to big picture, if you own valuable assets that are creating value, that's going to be the key.
Thank you, Kelly. Appreciate the education, and hope everybody out there is doing well. If you have any questions or you want to talk, please feel free to give us a call. We're always available. Thank you again for your trust. And let us know if you'd like to get on the line and talk.
Thank
you.